Welcome to the Thomson Reuters Idea of the Week and Alpha Now. I'm John Cozy. With investor focus on the Eurozone again, it's easy to forget about things like what U.S. tax rates are going to be for 2013. Unless the U.S. Congress acts before the end of the year, you may see taxable investors moving out of dividend-paying stocks like Johnson & Johnson, ExxonMobil, and Merck. Investors could be facing as much as a 44.8% tax rate when Obamacare surcharges are included. Here's a strategy that eases the pain in case tax rates go up. It's a plan that gets most of its returns through capital gains, whose rate may rise to 23.8%, but that rate's still lower than the highest potential dividend rate. Names here include the likes of credit card issuers Visa and Discover, software giant Oracle, and global entertainment company Disney. These names came up on our StarMine screening process of companies with low dividend yields and low payout rates. According to a study by Credit Suisse, that's the second best investment strategy over the past 2 decades. Top performance honors go to high yield and low payout stocks. But if dividend tax rates rise enough, taxable investors may be heading for the exits really fast into the names like the ones we just mentioned. The screening process also ditched companies with the lowest 20% of earnings sustainability by using StarMine's earnings quality or EQ scores. For the 12 months ended in June, top EQ ranks gained 2%, but bottom ranks lost 20%, and that's why we care about earnings quality. The screening gathered over 110 names in every sector except utilities. The highest number of companies were in consumer discretionary and industrials, with the entire list attached in the text version of this video. We charted the portfolio's top 80% of market cap using Datastream Professional Portfolio Analytics, shown here. Year to date, it's a bit ahead of the S&P, but you can see the growth year bias of the portfolio's blue line jump in a big way when investors were less nervous in the first quarter of the year. Payment services company Discover Financial, the folks who brought you the first cashback rewards program, is one portfolio member that could return more in capital appreciation than in taxable dividends. Up over 50% year to date, it sports a recent 1.1% yield and retains over 90% of trailing 12-month earnings. The company's CFO mentioned that Dodd-Frank actually helped the company become more careful in its target marketing. A combination of global partnering and expansion into student and personal loans appears to bode well for investors. You'll also like this portfolio if you think a QE3 announcement will push stocks higher. A lot of its members have above average market growth. And whether tax rates rise in the future, low dividend yield with low dividend payout stocks have, over time, beaten the market. For the Thomson Reuters Idea of the Week and Alpha Now, I'm John Cozy.